we will learn about the Rule of 72, a simple tool for estimating investment growth. The Rule of 72 is a simple yet powerful mental math trick that helps you estimate how long it will take for your investment to double in value. Here's how it works. The formula: divide 72 by the annual rate of return, expressed as a percentage, on your investment. For example, if your investment earns 8% interest per year, it will take approximately 72 divided by 8, which gives us 9 years for your money to double. Is that clear? You may be wondering, what exactly is the usefulness of the Rule of 72? Investment planning. It provides a quick estimate of how long it will take your investments to grow significantly. You can easily compare the growth potential of different investments with varying interest rates. The Rule of 72 can help you set realistic financial goals and timelines for achieving them. Understanding inflation. The Rule of 72 can also be used to estimate how long it will take for the purchasing power of your money to be halved due to inflation. For example, if the inflation rate is 4%, your money will lose half its purchasing power in approximately 72 divided by 4, which is 18 years. Are you following? Limitations of the Rule of 72. Approximation. The Rule of 72 provides an estimate, not an exact calculation. Accuracy decreases at higher rates. It's most accurate for interest rates between 5% and 10%. For higher or lower rates, the accuracy diminishes slightly. In summary, the Rule of 72 is a valuable tool for investors and anyone interested in understanding the power of compound interest. While it's a simplification, it provides a quick and easy way to estimate the time it takes for your money to double, helping you make informed financial decisions. This information is for general knowledge and educational purposes only, and does not constitute financial advice. Is that taken? Thanks for watching.